The Honest Company stock is down 85% since its IPO in 2021. The stock has fallen 45% in the past 6 months because they reported bad earnings. Let's see if this is a good opportunity to buy the company by looking at the fundamentals and running a DCF model to calculate the intrinsic value of the company and potential future returns. Despite being a small cap company with a market cap of $300 million, they are not growing fast. Their revenue has grown from $235 million to $383 million in the past 5 years. And in their last quarter, they reported negative 7% revenue growth and negative 5% organic revenue compared to last year. Despite this decline, analysts are expecting positive revenue growth over the next 3 years, as they are expecting Honest to reach $403 million this year and grow to $442 million, which is approximately revenue growth of 5% per year. They sell diapers and wipes, skin and personal care, and household and wellness products from a sustainable and wellness angle. Regarding profit, this is a company that has recently turned profitable, and they are generating $7 million in net income. However, they are currently free cash flow negative with negative $21 million. Analysts are expecting small profit growth over the next few years, as they have Honest making 10 cents per share this year and grow to 11 cents per share in 3 years. A negative aspect about their financials is the number of shares outstanding. They have been issuing a ton of shares in the past years, which is horrible for investors as you share the profits with more people and your returns will suffer. Then, in order to calculate the intrinsic value of the company and potential future returns, I use my discounted cash flow model. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $1.8 per share, middle 3.8, and high 6.7. And because the stock is currently trading at 2.7, this means that if my low assumptions occur, you would get a 2.5% annual return on your money, middle 17%, and high 29%. As far as my assumptions, I assume Honest grows revenue between 3 and 7% annually for the next 7 years, the average of profit margin and free cash flow margin between 4 and 10%. This is the hard part about valuing Honest because they just turned profitable, but their gross margin is around 37%, so maybe they can achieve these numbers. Finally, I assigned the PM price to free cash flow at the end of the 7 years of 12, 14, and 16, but if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. A very positive aspect about Honest is their balance sheet. They have $71 million in cash and only 6 in debt, which is amazing and something definitely to take into account. However, although I believe they are innovating in this sector and they have an exceptional balance sheet, they have a very low revenue growth and even guided negative for the rest of the year. They are diluting shareholders and there is still a lot of unknown about the future of this company. For these reasons, I am going to pass for now. Lastly, if you want a discount on stockanalysis.com, the best place for stock data, grab my code in the description. I hope you found this video valuable. Let me know what you think about Honest Company in the comments, and I'll see you in the next one.